Long-term yields are hovering near cycle highs while equities sit just below records, and that tension is starting to bite across sectors. Welcome to vTalkInsight, Equity Pulse Daily for August 20th, 2026, where we connect the macro policy backdrop, the AI capital cycle, and company results to today's equity market risk and opportunity. Global equities are trading in the crosshairs of a powerful rates move and still strong growth data. The S&P 500 has only slipped modestly from its highs after yesterday's small rebound, while the VIX sits in the mid-teens, pointing to contained but rising unease as bond yields grind higher again. Across regions, bond yields are pushing up, driven not just by the Federal Reserve, but also by persistent inflation, firmer energy prices, and heavy sovereign and corporate issuance. 10 and 30-year U.S. yields are hovering around the 4 to 5% range that many now see as a new normal, even as real long-end yields above 3% start to feel restrictive for risk assets. That backdrop is draining liquidity and reasserting the classic negative correlation between yields and equities. We have already seen that when the 10-year yield troughed last October, S&P 500 valuations peaked, and some estimates now suggest a further rise in 30-year real yields toward roughly 3.5% could be enough to erase year-to-date equity gains. Monetary policy communication is amplifying this tension. With the Fed offering limited forward guidance and Chair Powell seen as ambiguous, markets are hypersensitive to the upcoming FOMC minutes, the Jackson Hole meeting, and the September decision, especially with core PCE inflation expected to stay above 3% through at least 2026. Minutes indicate that a meaningful group of Fed participants is prepared to back another hike if inflation or labor data reaccelerate, even as the consensus view in markets still leans toward a prolonged pause. Some see the risk of additional tightening being underpriced, with scenarios of as much as 100 basis points of extra hikes over the next 6 months if the data break the wrong way. Treasury curve management adds another twist. The decision to at least double long and buyback operations from $2 to $4 billion per auction triggered a sharp rally in 30-year bonds, a weaker dollar, and a quick risk-on pop in equities and gold, showing how sensitive positioning is to liquidity signals. Yet most of the underlying drivers of higher yields remain intact. Persistent large U.S. fiscal deficits, surging net interest costs, and record investment-grade issuance, much of it AI-related, are all pushing the equilibrium interest rate higher and keeping upward pressure on the back end of the curve despite tactical buybacks. For equities, this means long-duration growth and mega-cap tech names face ongoing multiple pressure, while value styles and cash-generative cyclicals look relatively better placed in this rates regime. At the same time, strong earnings across 10 of 11 S&P sectors and even an 8,400 year-end target based on rising forward earnings and a 20 times multiple underscore that the profit cycle still supports the tape if yields can avoid another lurch higher. Energy is the second major macro shock running alongside higher rates. Escalating tensions around Iran, including the UAE severing economic ties, missile threats, and tanker attacks, have slashed traffic through the Strait of Hormuz and pushed Brent crude above $90 a barrel for 4 straight sessions. Rising oil and diesel prices are feeding directly into input costs for agriculture, manufacturing, and logistics. Companies now face a binary choice between passing those costs through to consumers, risking demand, or absorbing them in margins, raising the specter of a mild stagflation backdrop in some economies. The UK offers a good illustration. A jump in the energy price cap is pushing headline inflation higher, with core CPI surprising to the upside, even as the labor market shows slack and the Bank of England is widely expected to stay on hold, highlighting diverging domestic and U.S. conditions. On the equity side, these shocks are driving sharp regional divergences. Asian markets have borne the brunt, with the MSCI Asia Index down about 2% and South Korea's Kospi off nearly 6% as higher yields and elevated oil prices collide with a deep semiconductor sell-off. In contrast, European indices are flat to slightly higher and realized volatility is at its lowest for this time of year in 2 decades. basic resources and energy are outperforming on stronger commodity and critical metal prices, while sectors like media lag, signaling a rotation toward beneficiaries of the energy and infrastructure cycle rather than a broad risk-off capitulation. In the U.S., recent sessions have shown a similar pattern, with technology down more than 2% while consumer staples, energy, and materials outperform. The message from the tape is that energy and geopolitics are reinforcing the rate shock, nudging leadership away from long-duration growth and toward cash-flowing, real asset-linked sectors. The other powerful force reshaping equities is the AI capital cycle. Corporate AI spending has surged nearly 21-fold over the past year, making it one of the fastest technology build-outs in history, and AI-driven Capex and equity gains are now key pillars of overall economic momentum. That investment boom is showing up clearly in credit markets. U.S. investment-grade issuance is up 34% year-on-year to around $1.6 trillion, with AI-related borrowers jumping from just 1% of supply in 2024 to about 18% this year, and hyperscaler deals often pricing with an extra 20 to 50 basis points of spread. Some technology names are now issuing debt with coupons close to 7%, and Alphabet's recent Australian bond price near 6.98% underlines how even top-tier AI-exposed corporates are paying meaningfully higher funding costs as long-end yields rise. For equity markets, that raises questions about future free cash flow, capital allocation, and whether bonds are starting to draw marginal dollars away from richly valued AI stocks. Heavy AI infrastructure issuance is also competing with treasuries for duration demand, contributing to the upward pressure on government borrowing costs already fueled by large fiscal deficits. At the same time, a growing view holds that the public investment-grade market is nearing saturation, with roughly $4.5 trillion of dry powder in private credit poised to fund around a quarter of multi-trillion-dollar AI projects over the next 5 years. Against that backdrop, private markets are increasingly seen as essential for both alpha and diversification, especially as public equity valuations stay elevated and stock-bond correlations turn more volatile. Tokenization initiatives, such as Robinhood's blockchain-based trading of tokenized U.S. stocks in over 120 countries, hint at a future where both public and private assets trade with greater liquidity, even as regulators grapple with how to protect investors in this new infrastructure. Within AI itself, attention is turning to market structure and policy risk. Firms like Anthropic are reporting revenue growth of around 800% with rapidly improving margins, and valuations of 25 to 30 times trailing revenue for Anthropic and OpenAI are viewed by some as reasonable if the sector evolves into an oligopoly with durable pricing power. However, the financing and build-out of data centers now face a political and social backlash. In the U.S., local opposition has blocked roughly $130 billion of projects in just 3 months. Texas has paused new grid approvals amid fears data centers could push power demand 5-fold above records, and negative public sentiment is creating reputational and regulatory risks, even as the federal government remains committed to AI infrastructure for strategic competition with China. Company-level signals show how these macro forces filter into specific sectors. In semiconductors, Asian chip stocks have sold off sharply, with the regional index down about 5% as higher yields, heavy AI-related issuance, and anticipation of marquee AI IPOs like OpenAI and Anthropic draw capital away from existing names. South Korea's SK Hynix helped stabilize the space by unveiling a roughly $29 to $30 billion share buyback and cancellation, reversing prior dilution and leveraging record AI cash flows to support the stock. In Europe, ASML remains the largest positive contributor to equity indices despite broader tech weakness, while Taiwan's semiconductor is highlighted for strong monthly revenue growth and unique leadership in advanced manufacturing, even as its share price is pulled back. Beyond chips, Arista Networks continues to post accelerating revenue growth as it rides AI networking demand alongside peers like Cisco and Ciena. That underscores that the AI value chain extends well beyond semiconductor leaders into switches, optical networking, and data center infrastructure, supporting a broader set of earnings winners. Healthcare is another bright spot. Moderna shares have surged more than 60% after a late-stage trial showed its individualized mRNA cancer therapy, when combined with Merck's Keytruda, significantly reduced melanoma recurrence or death, with benefits persisting up to 5 years in earlier data. Merck has described the results as clinically meaningful, suggesting a 30 to 35% cut in recurrence risk, and the success marks a major validation of mRNA technology beyond infectious disease. Regulators will now scrutinize efficacy and safety in detail, but if approved, this could dramatically expand Moderna's addressable market in oncology and reinvigorate interest in innovative biotech and large-cap pharma growth pipelines. U.S. consumer-facing names paint a picture of cautious resilience. Target has delivered 2 consecutive quarters of better sales and margins, with comparable sales up 3.8% and store traffic up 3.6%, raising its full-year outlook as merchandising and pricing initiatives bring shoppers back, even if the share price reaction suggests much of the turnaround was anticipated. Walmart is expected to post solid same-store growth near 3.8%, but without a major guidance upgrade. Home Depot has surprised positively as smaller ticket home improvement proves resilient, while Lowe's has cut its outlook as high mortgage rates delay larger renovation projects. Together with still strong credit card data but weak consumer sentiment readings, the message is that households are stretched but far from capitulation, skewing spend toward essentials and value. In Europe, Carlsberg has raised its full-year growth outlook toward the top of its range, helped by strong summer trading, synergy gains, and a 9% first-half increase in its soft drink segment, which now makes up roughly a third of the business and offsets weaker beer volumes. Management is also increasingly focused on supply chain security as volatile weather disrupts crops, a theme echoed across consumer staples as climate risks intersect with margin management. Chinese robotics highlight the speculative edge of the current cycle. Unitree's IPO saw the retail tranche oversubscribed about 5,500 times and the stock surge as much as 630%, leaving it on a trailing price earnings multiple near 1,200 before some profit-taking, while Unitree's Shanghai listing jumped roughly 460% and stands out as one of the few profitable humanoid robotics players. At the same time, Big Tech is facing a very different kind of risk. A landmark trial against Meta carries potential penalties of up to $1.4 trillion and could set precedents on design and age verification that reshape user engagement and monetization models across social media, adding another regulatory risk premium to parts of the growth complex. Pulling this together, today's equity market sits at the junction of 3 powerful forces: structurally higher long-term yields, an energy and geopolitics shock centered on the Middle East, and an AI investment cycle that is both supporting growth and driving up the cost of capital. Earnings across most sectors remain robust, credit markets are still absorbing record issuance, and selective winners in semiconductors, healthcare, consumer staples, and AI infrastructure continue to emerge, even as valuations in some robotics and software names look increasingly stretched and long-duration growth trades feel the squeeze from higher real rates. From here, the key signals to watch are the Fed minutes and Jackson Hole messaging, the next PCE and CPI prints, the path of long and real yields versus that 3.5% threshold, the durability of oil above $90, and how AI-related credit and regulatory developments evolve around data centers and big platforms. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.